What is Section 409A and how does it affect my company? Well, in most situations, Section 409A deals with what's called deferred compensation. So the IRS doesn't want people basically receiving deferred compensation or compensation that's unreported and therefore on which people don't pay income taxes. In other words, the IRS wants you to pay taxes on all of the amount of compensation that you receive. How it affects most companies is that companies are issuing stock and stock options to employees and other key service providers in exchange for services. So the IRS considers the stock or the stock options that somebody receives as compensation. So if you were giving someone stock without paying for it, or if you're giving them options with an artificially low strike price that doesn't show the fair market value of the company, then the IRS says that should be included in someone's taxable income, and both the company has an obligation to withhold payroll taxes on that amount, and the employee or the individual receiving that property has the obligation to pay income tax on that amount. So in a company that's rapidly scaling and increasing in value, the fair market value of the options strike price and the actual restricted stock that's given to employees becomes pretty important. 409A outlines some of the things that companies can do to protect themselves and their employees. So for example, it establishes a safe harbor which says that if the company employs one of these methods, it can have a presumption that it's given the stock options or the stock a fair market value price when it's reporting these things and giving them to employees. Now, the two main safe harbors that companies tend to use when they're in their private growth stage are either one, an internal report by what's called a qualified individual. And a qualified individual in this particular safe harbor rule would be someone who has an experience in private equity, lending, business valuations or business approvals, investment banking, or other kind of financial type of services that are provided. And that person does an internal valuation report justifying his or her findings. Now, what that can do is it can give someone a safe harbor that the strike price they picked for their options or the value they're attributing to their stock that they're granting to people is actually the fair market value. A more common method that companies are using these days is by hiring an independent valuation firm. So many cap table management software out there, as well as independent appraisal firms, abound on the internet. And as long as those appraisers are independent, then you can get a valuation report from one of those groups, often for not much more than $1,000 or a couple $100 or even a couple $1,000, and that will give the board of directors confidence that its option strike price is set at fair market value, thereby avoiding a taxable impact to the employees and a withholding obligation on behalf of the company. Again, it doesn't mean that it's foolproof and the IRS can never question it, but if any party is audited, it means that the IRS would have the burden of showing that such a report, either internal or an external independent valuation, is grossly unreasonable under the circumstances, which is a very hard burden to prove and can be very valuable to the company.